Welcome to our channel. Today, we're unlocking the secrets of present value relations, a key concept in finance. Whether you're new to finance or looking to brush up on the basics, this video is for you. Let's dive in. Imagine someone promises to give you $100 a year from now. Would you rather have that $100 today or wait a year? Most of us would take it today, and that's because of the time value of money. Present value helps us figure out how much future cash flows are worth in today's terms. It's like bringing the future into the present, allowing us to make better financial decisions. In finance, an asset is any resource that generates cash flows. This could be tangible assets like real estate or intangible ones like patents. When companies evaluate assets, they consider the sequence of cash flows those assets will generate. The key is to determine the present value of these cash flows. Think of cash flows at different times as different currencies. Just like you wouldn't add yen and pounds without converting them, you can't add cash flows from different years without converting them to present value. Let's see how this works in practice. Suppose you have to decide whether to invest in a project today that will pay off in the future. By calculating the present value of future cash flows, you can determine if the investment is worth it. The time value of money is the principle that $1 today is worth more than $1 in the future. Why? Because you can invest it and earn a return. For example, with a 5% interest rate, $1 today grows to $1.05 in a year. The reverse is also true. $1 in the future is worth less today because of the missed opportunity to invest it. Net present value, or NPV, is a key concept in finance. It tells you if an investment is worthwhile by comparing the present value of cash inflows to the present value of cash outflows. Let's look at an example. Imagine a project that requires an initial investment today, with expected returns over the next few years. By calculating the NPV, we can see if the returns justify the investment. A perpetuity is a special type of cash flow that continues forever. For example, a bond that pays interest indefinitely is a perpetuity. We can calculate its value by dividing the annual cash flow by the interest rate. If the cash flow grows over time, we have a growing perpetuity. This is slightly more complex to value but follows the same principle. An annuity is a series of fixed payments over a specified period. Think of a retirement plan that pays out a fixed amount every year for 20 years. Let's say you win the lottery, and it pays $100,000 a year for 20 years. To find out if you're a millionaire today, you would calculate the present value of these payments. Interest can be compounded more frequently than annually. The more often it's compounded, the more interest you earn, or the more you own. This concept is crucial for understanding loans, investments, and savings. Inflation reduces the purchasing power of money over time. When calculating present value, it's essential to consider inflation to ensure that cash flows are treated consistently. For instance, if you expect your earnings to grow at 2% annually with a 5% interest rate, we can calculate the present value of your income, adjusted for inflation, to see what it's truly worth today. Let's recap. Present value helps us compare cash flows across different times. Assets are valued based on the present value of their future cash flows. The time value of money explains why $1 today is worth more than $1 in the future. Special cash flows like perpetuities and annuities require unique valuation methods. Compounding and inflation are crucial factors in financial calculations. Thanks for watching. If you found this video helpful, please like, subscribe, and hit the notification bell so you don't miss our next finance deep dive. Have any questions? Drop them in the comments below, and we'll be sure to get back to you. See you in the next video.